Hello, thanks for joining me on today's episode of the Simply Financial Podcast. I'm your host, Christopher Calandra, and I want to increase your financial IQ with today's episode, which is the third part in a three-part series I have been doing on the major market indexes, the basics of those. And like I did with the previous two episodes, and I strongly recommend you go back and listen to those two before listening to this, although this will stand on its own. The original thesis is you tune into the news or you hop on your computer and you look at what the market's doing, and you might see the Dow is up X, the S&P 500 is up Y, and maybe the NASDAQ is down such and such. These indexes are very important. You might even be a little familiar with them, but actually, how much do you know about them? This really brief three-part series is meant to reveal a little more information to kind of help you along in your financial journey. So in the first episode, we covered the Dow Jones Industrial Average. In the second episode, we covered the S&P 500, the Standard & Poor's 500. And on this, the final episode, we're going to cover the NASDAQ. Now, technically, the NASDAQ has a couple of indexes, but the dominant one, the one that you see on the news, the one that is most widely followed is the NASDAQ Composite Index. That's the more formal name. Not NASDAQ, but NASDAQ Composite Index. NASDAQ is just the shorthand. It is, again, the most common. It tracks all 3,000 plus companies that are listed on the NASDAQ exchange. If you had listened to the previous two episodes, and again, I hope you did, the Dow consists of 30 companies, the S&P 500 consists of 500 companies, and the NASDAQ consists of over 3,000 companies. So it really gives you a wide variety of companies. It is heavily weighted, the NASDAQ is heavily weighted to tech, to biotech, and internet companies. It is a much more modern, if you will, index. It doesn't have as many old school industrial companies compared to the Dow and the S&P 500. You don't see nearly as much, say, oil companies or manufacturing companies. You find, again, a lot of tech, biotech, internet companies. It is a more risky index compared to the other two. It typically has higher risk and greater volatility. That's what we've seen since it came into existence back in 1971. So the NASDAQ is meant to be a proxy for a segment of the stock market best described as tech, biotech, and internet companies. That's the key takeaway. Incredibly, when this was created in 1971, it gave us the world's first electronic stock market. The Dow and the S&P 500 mostly consists of New York Stock Exchange oriented companies and large companies. The NASDAQ, which is, with its listing of 3,000, has included in it lots of smaller companies that are not yet fully mature and have not grown enough, may never grow enough for inclusion in one of the other two indexes. But when it was created in 1971, it gave us the world's first electronic stock market. Clearly, technology in 1971 is not what it is today, but it did give birth to electronic trading, electronic stock market, giving us access, more easy access to companies that we didn't before then, when we were more reliant on, back then, just the New York Stock Exchange, but also the American Stock Exchange. So the NASDAQ, typically higher risk and greater volatility. What you find is in good years, more often than not, I'm just talking general rules now, don't take this to the bank, is that in a really good year for the stock market, the NASDAQ is likely to outperform, or more often than not is going to outperform the Dow and the S&P 500. That's not a foolproof rule, but just a good rule of thumb, something to consider. But when things don't do well and the markets struggle, the NASDAQ will often have larger losses than the other two indexes. And it sort of makes sense because those old school companies the large industrial companies that make up the Dow Jones and the large companies that make up the S&P 500, they have a little more staying power, a little more track record of success, larger company models, more customers, more assets, more money in the bank. Again, general rule, but that's what you experience with the NASDAQ. So you have the three major indexes. You have the Dow Jones Industrial Average, which is largely industrial, makes up 30 companies, made up of 30 companies. The S&P 500, also large companies, but not so industrial, largest 500 companies in the US. And then you have the NASDAQ. And those are the big three in terms of indexes that most people, most news will revolve around. There are many, many other indexes, dozens, if not hundreds. There's the S&P 500, the S&P 400 mid-cap index. There is the NASDAQ 100. There are international indexes. There's all kinds of different indexes. But in the three-part series, I gave you the background and a little history of the three major ones. I hope you found the information, not just in this episode, but all three to be worthwhile. I really do hope so. I will be back with you on the next episode of the Simply Financial Podcast very soon. In the meantime, please subscribe to the show if you haven't done so already, the Simply Financial Podcast. Thanks for listening. Have a great day.
The views expressed are not necessarily the opinion of Osaic Wealth, Inc., and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information should be relied upon when coordinated with individual professional advice. Please note, the information being provided is strictly as a courtesy. When you link to any of the websites provided here, you are leaving this website. We make no representation as to the completeness or accuracy of information provided at these websites. Nor is the company liable for any direct or indirect technical or system issues or any consequences arising out of your access to or your use of third-party technologies, websites, information, and programs made available through this website. When you access one of these websites, you are leaving our website and assume total responsibility and risk for your use of the websites you are linking to. Securities and advisory services are offered through Osaic Wealth, Inc., member FINRA, SIPC. Insurance services offered through Elliott Wealth Management Services, LLC, not affiliated with Osaic Wealth, Inc.